13,682 on the index. Let's connect then with Saurabh Mukherjea, who's joining in from Marcellus Investment Managers. Good morning, Saurabh. And it's turning out to be quite a stellar market after that one day that certainly was rather nerve-wracking, perhaps owing to that overheated market. We seem to be back to our winning ways. How are you reading into the situation, especially given the fact that you do have quite a few rather unpleasant updates with respect to the coronavirus in the UK, lots of clampdowns coming in, but then on the other hand, it seems like our market's not taking too much cognizance.
I think across the world, we have to realize that the vaccinations across the world will take a long time. So I've been speaking to my friends and relatives in the UK where the vaccinations have begun, but it's going very, very slowly. And it doesn't look to me that anytime in the next 12 months, we'll be done with this, the whole drive to vaccinate the world. It'll probably take the best part of 2 years. So we've got to be prepared for this sort of 2 steps forward, 1 step back dynamic. This time it's hit the UK. Perhaps next time we won't be so lucky. And in that context of 2 steps forward and 1 step back, it obviously makes sense to invest in companies that benefit from this, the early stages of this economic recovery. We've been very emphatic since March that we're in the beginning of a economic recovery. Indian economic recoveries are driven by cheap money and cheap oil. We've got both of those and we're in the early stages of recovery. But because of this 2 steps forward, 1 step back dynamic, I would warrant that people should be careful about investing in quality. So by all means, play the high quality financials, play good auto companies to benefit from the recovery, but don't get suckered into low quality small caps. Don't get suckered into broken balance sheet financials or broken balance sheet companies in the power, infrastructure, real estate sector.
Fair enough. And I just wanted to also get in your views then, Saurabh, with what's going on within the IT space, because this has been one steady performer. The news bits as well have been very encouraging with respect to some of these multi-billion-dollar deals that have been signed with the likes of Infosys and Wipro. What's the pecking order when it comes to the IT basket and your stance on the future of the space?
I think first off, we've seen over the last 20 years that the leading Indian IT companies, especially TCS and Infosys, to a slightly lesser extent, HCL Tech and Wipro, the top 4 Indian IT companies have shown themselves to be very capable, very adept at changing their businesses to the changing needs of their Western clients. So when remote infrastructure management was doing well, HCL Tech made a lot of money from it. Now that we have moved into a world of remote working and a world where cloud clearly for companies across the world will be the way they will do business, it is relatively clear that the Indian companies have adapted very well to the post-COVID and the world of cloud computing. So the top 4 companies have shown themselves to be very adept. Clearly, Western technology trends change, and that's why I'll be wary of going down the market cap spectrum. Historically, we've been long-standing investors in TCS across several of our portfolios, and our faith in TCS stays. Like everybody else, we're excited by Accenture's bumper number recently. It's quite remarkable, actually, how strong the Accenture numbers are. And we are hoping that TCS too gets some of that business. So no need to sort of get carried away and go down the market cap spectrum and start investing in, monoline IT services firms. Stay with the giants, stay with TCS. Company has shown itself over the last 20, 30 years to be I would say the scale gorilla in Indian IT. I think it's nearly as large as it's next TCS is as large as the number 2 and number 3 companies in India put together. And 30% ROC, almost the entire PAT is paid out as a dividend. What can you complain about? You're getting scale, you're getting profits, you're getting dividends, and you're getting growth.
Saurabh, do you think this is the right time to perhaps relook at some of those consumption plays, which have otherwise been somewhat lagging in terms of any major traction?
So I suppose let's divide the consumption plays into staples, classical FMCG stocks such as, say, Nestle, which is a long-standing Marcellus favorite. Perhaps you could, depending on your taste, you would classify an Asian Paints and a Pidilite in that same basket of classical compounding companies whose products are part of day-to-day life in our country. And our view on that for a long, long time has been very simple. These are dominant franchises. They really have very little practical competition at the day-to-day level in the marketplace. And as a result, they have very high return on capital, which gives them heavy free cash flow, which they reinvest, and you compound at a steady 20% over long periods of time. The more exciting piece around consumption, where sort of pulse starts racing when the economic cycle picks up, is auto. And I think we've discussed in the past auto on your channel for the last 8-9 months. My view is that auto does very well in the first 3, 4, 5 years of an economic recovery. We are in that phase, and therefore frontline auto stocks like Maruti Suzuki, like Eicher Motors do make sense. They form part of several of our portfolios. And then the next part of the sort of discretionary consumption piece is this whole ecosystem around building materials, right? So tiles and sanitary ware, laminates and so on. In that ecosystem, we've tried to do a lot of work and find good companies. So far, Astral Poly is the only one where we've been able to build confidence, build faith that this company can give us, multi-year compounding as we go into what looks like a 3-4 year economic recovery in our country. So in the building materials piece, so far Astral Poly is our main play. I don't sort of see Asian Paints and Pidilite more as building materials. I see them more as FMCG, very reliable, very steady compounders. So if you divide consumption of that steady staples and more exciting plays on consumption, the auto piece we've loaded up quite nicely from March, April, June onwards, and we'll stay committed to auto for I think at least the next 2, 3, 4 years. The building material space, we're doing more work. So far, Astral Poly has been our main investment there.
Okay, fair enough. And within the pharma names as well, if I could just jump to that, given the kind of strength we continue to see, a whole host of buy calls that continue to come in. I know that each name there is a selective play, but what's the preference or opportunity? Would you perhaps expand your basket when it comes to some of the pharma healthcare names, given the kind of traction we continue to see there?
So look, I mean, a country does have several good pharma companies. So I've been a big admirer of Cipla for a long time. I've never bought the stock, but one can't but admire what Yusuf Hamid, his team, and this man and his family have done for Indian pharma. Remarkable company. But our challenge with classical Indian pharma stocks like Cipla, like Lupin, even say Sun Pharma is there's just so many moving parts to it that it's difficult for people like us on the outside to understand where exactly the competitive advantage lies. And in that context, a couple of years ago, we realized that there are two other pharma companies where it's much easier for us to understand the demand dynamics. So one is Divi's Lab. I've discussed it extensively on your channel over the last couple of years. If you take the world's top 20 APIs, in 9 of them, Divi's is the world's largest manufacturer. And we've done a lot of work on who exactly are Divi's clientele. And our reckoning is the world's 6 largest pharma companies are driving 80, perhaps even 90% of Divi's profit. So you can see the monopoly, you can see the client base, you can understand the business, and you go forward and commit to a long-term investment there, as we have done in Divi's. And the other pharma company where we've understood the business quite clearly and been able to commit significant parts of our portfolio is Abbott Labs. It's similar to Nestle in some regard. You're selling essential products like Vertin, like Tyronorm, like Remafin to the Indian public. You really, if you look at those categories, if you speak to general GPs in Bombay, Delhi, Bangalore, they'll tell you that it's very difficult to consider for a GP why they should recommend a competitor to Tyronorm or Vertin. So we understood why these are high quality drugs which generate heavy free cash flow for Abbott. We can't really see that much competition, and therefore we went and bought Abbott. Beyond those two, right, we find most of the other pharma names to be quite speculative in nature, with too many moving parts and very heavy regulatory uncertainty. So I would love to say, we would build a larger pharma portfolio beyond these two, but we've struggled to build conviction beyond these two. We've also got in our small and mid-cap portfolios names like Alkyl Amines, names like GMM Pfaudler, which feed into the ecosystem, feed into the supply ecosystem, which leads to Abbott and Divi's manufacturing their drugs. But in the frontline pharma names, it would be Divi's and Abbott Labs, which sit in our portfolio.
Saurabh, how is it that you treat financials now? Because, one thought that this is going to be the leader which is going to play catch up to the IT, pharma and Reliance rally. The catch up has happened, but again, you're seeing more of the same patterns in the market. People are buying more of IT, more of pharma. Sure, there are a few standalone cases like a Bajaj Finance, FinServ, HDFC, etc. But you haven't seen, a big move in the financial space. Private banks, PSU banks, all alike, and NBFCs as well. Even if I look at the month-to-date performance, Nifty Bank has given you a 1% uptick as opposed to Nifty IT's 11%.
So the way we have played this is we launched a portfolio in mid-July called Kings of Capital, and we stuffed it full with the best banks, the best NBFCs, and then with the best life insurer, general insurer, asset manager, and broker, right? So around 60% of Kings of Capital is lenders, 40%, 45% are the savings plays. Now, let's just discuss the lenders first. What's very interesting, what's super interesting is how the top 5-6 lenders have provisioned super heavily for COVID, right? The top 5-6 lenders have stashed away a huge amount of provision. So if I just had to give you a context, if you take the top 3 PSU banks, SBI, BOB, PNB, and compare them with, say, HDFC, Kotak, Bajaj, Axis Bank, say, take the top 5 or 6 private sector lenders, take the top 3 or 4 PSUs. The COVID provisioning is 6 to 7 times more for the private sector lenders than for the PSUs. And yet, if you look at the cumulative loan books, top 3 PSU banks and top 5 or 6 private sector loan books are similar size, but the private sector banks have provisioned 6 to 7 times more. And therefore, to my mind, sort of to use a popular aphorism these days, the Queen's Gambit move is load up on the top lenders, top private sector lenders who've already provisioned super heavily for COVID. Effectively, they're saying that if the private sector lenders, the leading private sector lenders are saying, take our Morad books, assume heavy NPAs there, heavy write-offs there, and we've already provisioned for that. Whereas the PSU banks are saying, well, we don't really have the tier 1, so we can't really provision. So it's a little bit waiting for lady luck to play out on the PSU side. So I think it's a straightforward story. By the top PSU banks, they've already provisioned super heavily for COVID. You can see it in their published numbers, and that's what we have done. The provisioning disparity is very, very stark. And it is but obvious that there will be COVID NPAs, COVID write-offs as we get into 2021. Then coming to the savings side, I'm sure you've heard about how brokerage accounts have been opened by, I think, 60 or 70 lakh brokerage accounts have been opened in the last 6-7 months. So we are trying to play that dynamic by investing in good brokers. We think life insurance, private sector life insurers, we reckon will have a super run because this whole dynamic around COVID is driving demand for life insurance. You can see that in the IRDA data, and we bought HDFC Life there as our main play with across several portfolios. We've built positions in HDFC Life. So good private sector lenders, not just the frontline names, but say even smaller banks like AU Small Finance Bank, City Union Bank. These are well-provisioned lenders. And then onto the savings side, where asset management, broking, and life insurance, I think, has several good years ahead of it. And HDFC Life is our chosen play on the life insurance piece.
The big juggernaut has surely stalled. Reliance Industries, and you were circumspect about it, about 4 to 5 months back when we spoke with you, saying that you don't see merit in holding on to Reliance for too long. What happens next? Because it's struggling around, sub 2000 levels.
I mean, what I said on your channel, I think twice you folks have asked me over the last 6 months, and twice I've said we can't quite figure out where the free cash flows will come from. We've been can't but admire how adroitly they're pivoting this business away from a traditional chemicals and oil refining business into retail, into technology, into telecom. But the challenge in all of this is, where do you generate the free cash flows from? We all know Indian retail is a tough game, whether it's for Flipkart, whether it's Amazon, whether it was Big Bazaar. Indian retail is a super tough game. It's not evident to us that beyond, say, a D-Mart or a Titan, too many people have generated free cash flow there. And then coming on to Indian telecom, we haven't seen anybody generate free cash flow in Indian telecom. So to the extent, we are a classical investing shop. We look for free cash flows. We look for dominant competitive advantages. We've been a little bit at a loss as to how do we build that thesis. We completely understand the scale of the transformation this company has pulled off. And I'm sure the transformation has a long way ahead to go. But the lack of clarity on future cash flows, and specifically lack of clarity on future free cash flows, has kept us away from putting this in our portfolio.
Right. Saurabh, we are now next going to speak to you in 2021. So highlight for us, what do you think are going to be the big trends that are going to emerge in the next year? Or is it going to be more of the same and a continuation of what has happened in 2020, as in the themes?
I think the three straightforward things that we are hoping to benefit from in Marcellus are, we think we haven't even begun, a proper recovery yet. This is still the closing stages of the unlock process. So as gradually the fear of COVID is shed in 2021, we will see a much sharper pickup in consumption, much sharper pickup in demand, especially in sectors like auto, sectors like building materials, consumer durables, and so on. Right. So we haven't seen nothing yet in terms of the demand pickup. The second thing is, we will, I think, get very sharp operating margin improvements because companies were able to crush costs during COVID. As demand recovers next year, the benefit of the demand recovery will be non-linear. There'll be disproportionately positive impact on bottom line. So if you believe what most people are saying, that in the next fiscal, we could grow GDP in real terms at, say, 8, 9, 10%, which means in nominal terms, GDP growth could be around 15%. You could expect lots of good companies to be doing 20-25% EPS growth in the next fiscal, and therefore we are trying to position our portfolios to benefit from good earnings growth in the next fiscal. And I think the third piece will be the polarization in the financial space. The point you just made a few minutes back. I think we will see that. It's obvious to us that the majority of lenders are not haven't provisioned properly for COVID. They will therefore feel pressures on their balance sheet. Already when we are doing our channel checks, it's evident that several lenders have been basically all but squeezed out of lending. They haven't got the balance sheet. They haven't got access to funding. I think the polarization in financials, especially in lenders, will become very apparent in the next fiscal.
Okay. Saurabh, great to have you on the show, and here's wishing you a very happy and healthy new year from all of us here.
Thanks, Aisha. Happy New Year to all of you, and a great Christmas break to all of you. Thank you.